In less than 2 decades, the Indian Premier League has reached a valuation of $18.5 billion. It now generates more value per match than any professional sports league in the world, with the exception of the NFL. Early private investors are capturing 36 times returns on team ownership, while retail capital flows primarily into the public stocks of the parent companies. Yet the data suggests consistent financial yields appear in secondary sectors, specifically the delivery logs of food apps and the seating charts of domestic airlines. This wealth is built on a centralized revenue sharing model engineered by the BCCI. By pool sharing media and sponsorship income, the league transforms the inherent volatility of a sports franchise into a predictable infrastructure like asset with guaranteed cash flows. The IPL is a high velocity economic cycle designed to funnel massive consumer liquidity through a very narrow 8-week window. Broadcasting rights are the primary engine of this growth. The valuation of these rights has expanded far beyond the initial market expectations of 2008. In the first 7 seasons, Sony held the rights for roughly $1 billion. By 2018, Star India secured the cycle for $2.55 billion. The BCCI then fragmented packages, forcing traditional networks to bid against streaming platforms. This drove the 2023-2027 rights to $6.2 billion. That bidding war was a one-time event. Disney and Reliance have since merged their Indian media operations to form JioStar. This consolidation effectively removes the competitive pressure required to keep inflating these media rights in future cycles. By controlling the broadcast, Reliance has built a digital moat. To watch the matches, viewers are funneled into a proprietary telecom and streaming ecosystem, making one conglomerate the gatekeeper for the league's advertising and data. The TEM franchises are controlled by a syndicate of India's largest conglomerates and global private equity firms. These owners treat the teams as high-value, illiquid assets. India's Cements demonstrated the scale of this appreciation by spinning off the Chennai Super Kings into a standalone entity. By 2026, the market value of the cricket team actually eclipsed the total valuation of its parent manufacturing company. In early 2026, United Spirits finalized the sale of Royal Challengers Bengaluru for $1.78 billion. The deal was a 100% all-cash transaction. This chart compares that exit to the team's purchase price in 2008. The original investment of $111 million resulted in a 36 times return on capital. For these private owners, the primary goal is capital appreciation. The value of the franchise grows regardless of seasonal operating profits, driven by the team's global footprint and the guaranteed revenue from the central media pool. Retail investors often seek exposure to this growth by purchasing shares in the public parent companies of these teams, such as Sun TV or RPSG Ventures. This strategy relies on a sum of the parts valuation. Investors hope a massive private market value of the sports team will eventually force a re-rating of the entire public stock. However, this overlooks the core business. In many cases, traditional operations like television or manufacturing face declining margins and rising debt. The market sometimes ignores these weaknesses, pricing the stock on the speculative value of the cricket team instead of actual corporate earnings. Consider RPSG Ventures, owner of the Lucknow Supergiants. Its stock price spiked nearly 20% following news of high-value franchise deals elsewhere, despite the parent group managing a consolidated net loss of 136 crore and a negative return on equity. Investing in these parent stocks is often a bet on a sports asset to hide the struggles of a traditional business. It is a high volatility strategy that separates the share price from the company's operational reality. The most effective way to leverage this tournament is to focus on the secondary consumption boom. Quick commerce platforms have become the structural beneficiaries of the 8-week season. Zomato's subsidiary Blinkit achieved a 202% year-over-year revenue surge by fulfilling the demand created by at-home viewing habits. These platforms use moment marketing, timing geo-targeted push notifications to trigger exactly during innings breaks when order volume is at its peak. Travel logistics provide another avenue for yield. Executing a 94-match schedule across 10 cities moves entire squads and thousands of support staff. For airlines like Indigo, this ensures high load factors and increased ticket yields throughout the first quarter. These indirect beneficiaries capture the transaction volume of the IPL without taking on the risks of managing an actual team or paying massive player salaries. While the financial scale of the league is clear, There are some that the current valuation cycle is reaching a ceiling. With the consolidation of Disney and Reliance, the league faces a monopsony risk. Without two or three major players competing for rights, the explosive price increases seen in previous years are unlikely to repeat. Broadcasters are currently carrying nearly $2 billion in cumulative losses. This debt limits their ability to continue inflating rights valuations in the 2028 cycle. The Indian Premier League acts as a high velocity multiplier for the broader economy. It reroutes consumer spending into digital first channels, creating the most value for the platforms that manage the infrastructure of Indian consumption.